Hello, everybody. Welcome to the Kelly Wealth Management fourth quarter review for 2016. I'm a bearded man that looks like Leo Kelly, and today I thought we would talk about the year in review and a little bit of outlook for what's to come, as well as the 800-pound gorilla in the room, which of course is the presidential election and our new president coming into office. So we start with a review of 2016, and as we can see on the first chart, 2016 was a year that was probably better than anyone expected would occur in February. We started the year with the markets moving down in a somewhat dramatic fashion. Actually, the worst start to a market in the market's history. February 11th, the market made a bottom and the market rallied. What's interesting is at the end of the year, of course, after the Donald Trump election, we saw the market have a somewhat dramatic rally. And that, of course, was the opposite of what was expected earlier when we heard the market pundits talk about a Donald Trump election would mean a pullback in stocks. So again, just a message that we have to be careful, that we can't just assume certain expectations. And when the whole market is certain that there's one outcome, very often the exact opposite occurs. Looking at the chart, small caps won the day, and that was really a rally late in the year. In fact, what we saw was small caps make an absolutely staggering recovery in November and December. Now, that was largely driven by the composition of the Trump rally, which we'll talk about in a couple slides. High yield, fixed income did very well, up 14%. U.S. large cap stocks, 12%. And so this was really an outstanding rally. Fixed income did okay this year, but we did see interest rates shoot up right at the end of the year. And once again, they're at a very precarious position right now, and we do need to talk about that. So let's dig in. So the obvious 800-pound gorilla in the room, as we talked about, is the presidential election. Donald Trump's elected president, and what we will remember about the evening in which he was elected is the dramatic fireworks in the stock market futures. As the night was wearing on and it was becoming more and more certain that Donald Trump was going to actually win, the stock market futures started to go down. So stock market futures are traded and they're in anticipation of what's going to happen in the market the following day. Well, when it was actually confirmed that Donald Trump was going to be our next president, as you can see on the chart, the Dow Jones futures absolutely cratered, down almost 800 points. And depending on what news agency you were watching that night, people were talking about a big stock market crash and what was going to happen. And is it a buying opportunity? Is it the beginning of a bigger problem? Have we elected the wrong person? Is it going to crater the stock market? And what's absolutely fascinating about that whole 24-hour period is by the time the market opened, it was actually only down 100 and finished the day positive. So once again, it goes back to our election commentary that we did the day of the election. We can't fall into the trap of emotions. It's about fundamentals. It's about good, solid, fundamental structure of business, earnings, growth, so on and so forth. And so this was an emotional reaction, and as always the case, reacting to an emotional reaction usually does not yield profit. So Donald Trump is our president, and we had the Donald Trump rally. As we can see by the chart, what's interesting about the Trump rally is actually it was very narrow. And so as we hear people start to talk about, well, the market's rallying because business is regaining confidence, or because taxes are going to be significantly lowered, or there's an quote-unquote animal spirit, which is the new buzzword in the financial media today. I think the reality is, as we look at what actually did drive that Trump rally, I think what we're seeing here is a different conclusion. As we could see, what really drove the Trump rally was financials. Financials up almost 18% during the Trump rally to the end of the year. And as we go down, telecom services 15%, energy 10%, industrials 8.2%, materials 6.6%. Those were the areas of the market that actually beat the S&P 500. Other areas which had been popular, consumer discretionary and healthcare and obviously technology, utilities, consumer staples, the hot areas of the prior market actually all underperformed, and some were actually even down during the Trump rally. I think if we take a step back and we say, what is common about all of the areas that did well? what we would find is they're very highly regulated. So what the market's looking at right now is optimism. Optimism that new growth is going to come to the economy, and that's based on lower regulation. Yes, it's based on lower taxes, and it's based on a general feeling that business is ready to start to reinvest. I'm not saying that that's the case. We don't know yet. It's still well too early. But this is the vote the market is making, and we base that on what has gone higher and what hasn't. So what's Donald Trump going to do? That's the big question. Well, as we see on this next page, here's a list of what Donald Trump is saying he wants to get done. Tax reform, fiscal policy, which is to build out infrastructure and try to drive the economy through government spending, repeal and replace Obamacare. Now, the actual repealing of Obamacare is going to be remarkably difficult. What they can do through the budget reconciliation process is significantly modify it to the point where it can't survive. I think what's going to be critical here, obviously, is will they have a replacement all ready to go when they do the repeal? And again, we don't know. That's yet to be seen. And because of all that uncertainty is why the healthcare sector has struggled since Donald Trump's election. Trade, obviously, this is probably one of our biggest worries. The feeling of protectionism. So yes, we all want jobs in America. Yes, we all want manufacturing to come back. That's a great thing. We've talked about it for years. And yes, we want to make America great again. However, is protectionism the answer? Well, what we have to remember is over the last several decades, as the United States started to offshore, that drove innovation. And so what I always talk about is think about the companies that didn't exist 20 years ago. And as we look at the manufacturing renaissance, it would be great to have these jobs come back. I just don't want to overstate it. I think a great headline to reference is GM just a couple days ago said, we're going to invest $1 billion here in the United States in manufacturing. And you know what that created? 1,000 jobs. $1 billion, 1,000 jobs. Happy to have the 1,000 jobs. Think that's a great story. But if protectionism goes too far and we start doing heavy tariffs and that starts trade wars, I think that's a real threat. Let's hope this is a nice, happy medium where we can bring jobs back through incentive and through driving optimism in business that they want to invest in the U.S. Obviously, immigration, a hot button, and regulation. As we discussed, regulation, I think, is often overlooked as to its impact on the growth of business. Not to say we shouldn't have regulation. We absolutely need regulation. But the question is, has it become too onerous? And once again, the stock market is saying we think it has, and that the reduction of regulation, not the elimination, but the reduction is positive. So we look at the market, and one of the questions that we're getting on a pretty regular basis is, has it gone too far? This is a big move. This is a dramatic run. And so, again, the question, are we ready for a pullback? Are we overextended? As we look at valuations and we look at the average PEs over time, what we'll see is for equities, we're about at 20. Now, the decade of the 2000s, we were at 20. Market didn't do so well in that decade, one of the lower returns. But the decade prior, our average PE was 19.5, and that was one of the best. And so I think what's probably more important than just looking at PE is PE relative to what's going on. In other words, where are interest rates? They're still incredibly low. Low interest rates, we can withstand higher PEs. I think what's also important when we look at PE is, are we at maximum earnings capacity in the economy? Are we actually driving earnings, or is something happening in the market that's falsely or maybe temporarily lowering earnings, which drives up PE, price over earnings? And in this particular case, the answer is yes. Energy, materials, commodities, all of those stocks, the companies of those stocks, they're not earning anywhere near what they did in the past. And in fact, with the dramatic pullback last year in oil, last year's earnings cycle for energy, industrial stocks that support energy and materials, all of those absolutely cratered, many of them losing money. That makes the overall earnings for the S&P go down. That drives PEs higher. So are we overextended? Well, we're certainly not at the cheapest level. And yes, it's really a point where we want to be very careful in this market. But no, overextended. We're not quite in that camp yet. I would point out, though, we have not had a bear market this decade. We get 2 bear markets a decade on average, and we have not had one yet. And we haven't had a correction in quite some time. So once again, we're careful, we're optimistic, but we understand volatility is going to be a part of the ongoing market as we move forward. Volatility is not necessarily bad. Buy when things are low, add assets at cheaper prices, and that adds value to your portfolio. Now, where we are concerned, though, is on the bottom right, and that's the average bond PE. Again, PEs are not just for stocks, price over earnings. With a bond, the price of the bond is the face value, $1,000, for example. The E is the bond payment, the interest payment. That's your earnings. So as an investor, you pay a price, you get the interest rate, that's your earnings. Now we know there's no growth. At the end of the bond period, you get your money back. And so as we look at the PE of bonds, we're at a 40 today. So our PE for bonds is twice as high as stocks, and we get no growth. So that's really important. That to us looks very expensive. We have been talking about this. Interest rates this year have really started to move quickly. I'm going to show you a chart here on the next page. But more importantly, as you look back in history, this is not the same as stocks. Stocks at a 20 PE look very similar to history in many, many cases. Here, we're at really the highest levels that we've seen in decades. The next chart will actually show over the last 35 years where yields are. So the chart that you see here shows the yield on the 10-year Treasury. And the channel that's drawn out here on the chart is a downtrend. So what it basically does is it says it charts the lows and the highs, as you can see, up, down. And as we can see, you make lower lows, you make lower highs, and it starts to find a very specific pattern. And so for technical analysts, these are important patterns, and they follow these. And the theory goes, if you break the line on one side or the other, a dramatic move should ensue. Well, what's interesting about this chart is this goes back all the way to 1980. This is 30 plus years of downward trend. Unbelievable. And so as we can see, this has followed a perfect trend down. So this latest dramatic move back up in interest rates is notable. We do think interest rates are going higher. We have inflation. We have a strong economy. We're well past the need for crisis intervention by the Fed. The Fed's talking about raising rates. The theme seems to be higher interest rates, but we haven't broken that 30-year trend line. Our concern is once we get to about 2.75 on the 10-year to 3, that this thing breaks out to the upside, and there's fundamentals to support that interest rate rise. So we're watching very closely the level of interest rates and do they break this trend. What's also interesting about the trend, if you then extend the charts back another 30 plus years, and you go back to 1945, you see an absolutely perfectly symmetrical run in interest rates. So 37 years, interest rates went from 2% all the way up to basically 15, 16%. Let's stop for 1 second. It's important to remember that when interest rates go up, the value of your bond goes down. If you hold a bond at, say, 5% and interest rates go to 7%, obviously you can't sell your bond at par value, because why would anybody buy your 5% if they can buy it at 7% and get a higher interest rate on the market? How do you sell it? You discount it. Price goes down. And so what we see is a 37-year bear market in bonds, interest rates up, values down, followed by a 35 now going into 36-year bull market. The exact opposite is true. If you have a 7% bond, it goes to 5%. Obviously, your bond is more valuable because you're getting 7% and the market can only buy 5%. So from roughly 1983-84 to today, we have seen nothing but a straight downward movement in yields, therefore prices go higher. The symmetry here is interesting. And again, if you're a technical analyst and you look at this downward channel that's been created, you look at the fundamentals, I think if we drive through this extraordinarily long-term trend, obviously the symmetry says rates could go higher and it could be a long, long time. Now, obviously, we're more fundamental than we are technical, but this is what the market's looking at, and the fundamentals do support higher interest rates, something to take note. Also, in the conversation today, the dollar, it continues to rise. The chart here shows the dollar going back to 1998. The dollar ran up in the early part of last decade. We made our bottom in 2011. The dollar started to rise. But the notable move here was 2014. You see this dramatic lift in the dollar. And that's when the euro really came down significantly. This is all important. Right now, everybody expects the dollar to go higher, and it's logical. Our economy is doing better than the rest of the world. We're taking more of a pro-growth movement. We're going to do infrastructure spending. Everything that you talk about says our economy should do better than the rest of the world, therefore the dollar should go higher. There's more value here, there's more growth here. The question is it already priced in? And so, yes, I think there's room for the dollar to move. Are we going to see another move like we did in 2014? Nothing in the current fundamentals supports that. So we would have to have new information, a new surprise to create that kind of dramatic movement. And as we always say, it's not the number, it's the speed that you take to get to the number. Now, why is this dollar move and its strength, which it's maintained here in 2016 going into 2017, as you can see by that chart, why is it important? Well, the reason is Europe. So Europe has underperformed, and markets go in cycles, and so US outperforms, Europe outperforms. US has outperformed for the last several years, and so the chart, again, going back to these charts and these trends, the chart back to 2015, you see the Euro stocks in this downward trend, and then just this year, Europe has broken through the trend. Europe's been very strong since the election. And so we're starting to see Europe get some positive news. Manufacturing data is better, lead economic indicators are better. We're actually starting to see also an interesting market phenomena. We keep getting bad news and the market goes up. We get Brexit, the market goes up. So this is important. We like Europe. Remember, cheaper currency, dollar strong, euro's cheaper, pound is cheaper. That means their products are cheap around the world. It makes them more competitive. They have a far more accommodative central bank than the US. We're starting to see that actually show up in their economy. Europe looks very interesting to us. And you can see it in pricing. So as you can see here in continental Europe and the UK, the PEs are lower than the United States, somewhat significantly lower, and the dividend yields are higher. That's common for Europe. Dividends tend to be higher in that part of the world. Emerging markets look very inexpensive, a lot more risk there, a lot more currency risk there. So not something we can be very aggressive with, but something that obviously needs attention and obviously something we want to start to put money in front of as their PEs are the lowest in the world. So Europe looks good, big dividend, cheaper than the US, and a cycle to Europe over time, especially as we get volatility, makes some sense. Final chart on Europe is, again, a long-term chart that shows the back and forth between the US and Europe. And what you'll see is, since 1970, Europe and the US's returns are almost identical. But what the chart shows is they go through cycles. It's not back and forth one year to the next. And so you tend to have these long cycles, like in the late 80s, where we saw the European market outperform, followed by a long US market outperformance, back and forth, back and forth. And as you can see, for the last several years, 4 to 5 years, the US has outperformed. Are we ready to turn over? Valuation says yes, but what valuation does not do is predict when. All we can do is put capital where assets are cheap and then be patient and wait out the result. At a time like this, where we have a lot of volatility, where bonds are going to be a challenging part of the market, and we're going to have to manage very carefully, equities are a little higher, alternative investments make sense. They hedge a portfolio, and hopefully, if we pick them correctly, they give us better risk-adjusted return for an overall portfolio for having them in the portfolio. Private equity is probably one of our favorite places right now. But as we have said in prior calls, private equity in of itself is such a wide span of assets. It's what kind of private equity is very important. But back to the chart, as we can see, this chart shows, we just showed a chart about the PEs between Europe and the US. Now let's look at public versus private equity. And what we'll see is each year from 2011 through the third quarter of 2016, US public stocks, PEs, have accelerated from a 10 to a 12 to a 15 all the way up to a 20. We look at European public equity, and even though it's much cheaper, it's also gone higher. Now look at the private equity markets. It's stayed consistent, it's stayed level. They're not subject to market whims. They're not subject to constant movement, day by day, minute by minute in a stock market exchange. These are businesses, real estate, securities that are held. They're held privately on balance sheets, and they're not publicly traded, so therefore less volatility. They tend to be priced at their true value over time. So again, private equity looks less expensive, and obviously it's less volatile. Doesn't mean there's less risk. Risk is losing money, volatility is movement of price. And finally, with regard specifically to bonds and alternative investments, hedging strategies. So hedge funds, we've talked about those in the past. I mean, obviously the market sometimes gives them a bad name. There's good hedge funds, there's bad hedge funds. There's good mutual funds, there's bad mutual funds. The overall hedge fund strategy, if you actually use it as a hedge though, can be very effective, especially in rising interest rate environments. There are plenty of hedge funds that are designed to operate in a low risk environment and do well when interest rates are going high, therefore bond prices are going down. And as we can see on this final chart, since the 03 market, 03-07, we have 2008, 10, 13, 16. We took the last several events where interest rates moved back to our chart. Those were the upswings in the channel. In each one of these cases, the global hedge fund index, indicated here in the blue, significantly outperformed the Barclays Aggregate Bond Index. Rising interest rates, bonds are not going to do as well. And so again, this is an area in your portfolio that we think is important, and we especially think it's important in the environment we're in right now. So with that, we'll put the disclaimer up, and thank you for your time. Happy New Year. Thank you very much for being with us on this call. Hope it was helpful. If you have any questions, as always, please don't hesitate to call. Thanks again. Happy New Year. Look forward to seeing you soon.